Hello everyone. Today we have come up with an important topic. It is interesting, but rather than interesting, it is very vital if you are in the game of stock market. So the topic is capital protection. So before I get into this topic, I would like you to watch this short clip wherein Warren Buffett talks about capital preservation.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
From the clip which you saw now, it is very clear that the greatest investor of all time, which is Warren Buffett, is also emphasizing on the importance of capital protection. So capital protection, whether you call it capital protection, capital preservation, whatever. So it's like whatever you are putting into the stock market as your capital, as your starting capital, or whatever hard-earned money you are creating out of your business or from your salary, job, whatever. Obviously, you have to ensure that the sum you are putting into the market is multiplying, having a compounding effect. But above all of these things, the most important thing is that you should ensure that the money is not eroding or depreciating in value even after taking all this risk. So why somebody is investing in stock market is because compared to all fixed income assets like your FD or your corporate bonds or some PPF, PF, NPS, all those things, this is giving more returns comparatively. So what is the cost of that? The risk you take in that. So you should not take risk in such a way that you will endanger your capital itself. And say you have invested some amount and it is eroding to 50%. So it's like you didn't have a compounding effect, you didn't get profit out of that, and above all, you have lost money in that. So this is totally unacceptable and you should not invest like that. So the main agenda here is that you should ensure that you don't lose money in the market. And the rule 2, as Warren Buffett says, is that you stick to rule 1. So this is all theory. You would be saying like market is so volatile. So this is all theory you would be thinking, and you must be thinking that how I can protect the capital. The market is too volatile. The market goes down many times, so my capital also goes down along with that. So what I am saying here is that it's not that you will not have an erosion in your capital, but the thing is that if you have invested in quality companies after your thorough research, then it is very clear that even if for a short period of time, because of some macroeconomical factors or other things, the capital may go down in your investment, but if it is a quality company, then definitely their earnings power will help the company to uplift from all these things and again go up. So it's sure that even though you see a short-term volatility of your capital going down, going forward it will definitely fetch you higher returns. So there are stocks, even earlier in my portfolio I used to have some stocks which have eroded 70% and they have never come up at all. So those are all bigger mistakes people commit or investors commit these days without properly understanding the dynamics of the stock market. So the point which I am telling here is that even if you generate good profits in some stocks, if you erode majority of your capital through other stocks, then end of the day you will not be able to beat even a fixed income assets like FD. So for those investors, it is better to invest in a normal FD, sleep well, I would say, because you have created say 50% returns in one stock, and if the other stock has fallen 75%, and if the capital of that 75% erosion stock is more, then you are in a negative territory overall. So there is no point in such an investment. Now to state an example to have a clear understanding of what I am saying, say you have invested 50,000 rupees in a stock, say named ABC Limited. Now because of some lack of analysis or your poor understanding about the market or about the company is not fundamentally strong, and because of that, say the company has fallen by say 50%. Now 50% erosion in 50,000 is like 25,000. Now you are standing at 25,000. Now if you think that you will require just another 50% to reach back to your original investment of 50,000, you are thoroughly mistaken. Now if you see 25,000, now for that 25,000 to reach back to 50,000, then it has to increase by 100%, like double. So 25,000, double of 25,000 is 50,000. So that's the trick behind that. So 50,000 eroded to 25,000 just by 50% wealth erosion. But now that 25,000 to reach 50,000, you will require 100% returns. So 100% returns is not that easy, as you all know. So it takes a lot of time, and maybe it will not reach also. So for your 50,000 amount to make some sizable profit, say I would say for that 50,000 to become 1 lakh, so it's like double the return. So 50 becoming 1 lakh is double. So currently you are standing at 25,000. So 25,000 to become 1 lakh is like 4 times. So see the gap. So if you have a sizable wealth erosion, then to get back to your normal levels of investment of whatever original capital you have injected into the market, and to get profits above that, you will have to do a lot of work, and many times it is impossible to fetch such returns. So it is very important that you analyze your stock properly, so that you ensure that your capital doesn't erode. Now you will be thinking that how will I do that? So I'm not telling that you should not take any risk, zero risk. So there is no such thing that you take zero risk and get bigger returns. So if you need a bigger profit chunk, then you have to take your own risk. So there is a risk reward ratio analysis. So you should know whatever risk you are taking and what is the reward you are getting against that. And if that is not worth a try, never go with that. So it's not necessary that you have to always invest in high income generating assets like stocks. So sometimes if you see the market is consolidating, or if it is not the right time to invest, then you can invest in other low income generating assets like your even your FD or your bonds or your gold ETF or whatever, so that, or even real estate, so that you give some time for the market to stabilize, the stock market to stabilize. And if you think that this is an undervalued stock and it's the right time to enter the stock, then you can liquidate the other asset. Then whatever liquidation you have done in the other asset, you can reinvest that money into the stock market, so that you enter at the right price. As I always say, even if the company is good and if you are entering it at a wrong price, at a higher valuation, then it will not fetch you greater returns compared to a company, a good company, fallen down because of some other factors other than the microeconomical factors of the company, say some Russia-Ukraine war or some inflationary pressures from global markets. So based on that, if the stock is beaten down, then that is a time to enter the market. It's not necessary that anytime you enter a quality stock, then you will get good returns. So then you will have to hold it for a very long period to get sizable amount of returns. And also, as I always say, holding on for a very long period is also another way of making good profits. So you don't have to take tension that what will happen to this stock today, tomorrow, after a month, after a week, after 2 years or something like that. So if you hold long, then it is sure that that good company you have selected will definitely, because of its earning power, will return back greater returns in the form of dividends and in the form of compounding of the stock price. So that is another way of looking at it. So in my channel, as I always try to share you the fundamental analysis, the way you should invest in the stock, and you should consider the stock as a piece of business and analyze the business. Fundamental analysis has to be done, reflexive analysis has to be done. If you have not seen my earlier videos, I recommend you please go to the earlier videos. The series has got almost 80 plus videos wherein I have tried to share the ways by which you can analyze the stocks by yourself and get great insights on how to select undervalued stocks and then create great wealth going forward. So these days people are investing based on some analyst told something in the TV, in the newspaper, you got a video clipping, you have a friend who have told that I have got multi-bagger returns in that, so you also invest. So all those wrong way of channels or routes through which you get info wherein you blindly go and invest in such stocks is a bad way of investment. You have to do your own thorough analysis. You have to understand the business, you have to understand the business model, how they generate wealth. Is it cyclical in nature? Is it a consistent compounder, or is it like in 2 years they give a good return and then next 3 years they don't give a return? So all these things, there are a lot of dynamics in this, so you have to do all this analysis. Also you have to do a technical or reflexive analysis wherein you should know whether the stock is undervalued, or is it going to go to a very high peak in a short time, or is it already at a peak price, and is it going to fall in coming days? So all these things you should know before investing into a stock, so that you ensure that your capital is intact and you generate great wealth out of it. So performing your own due diligence is one important thing before getting into or buying a stock. Don't go with some market noise. Avoid herd mentality. People may buy, so you need not buy at that time. You can go against the herd. You can be a contra investor. So hope this session was informative for you and you took away some value from this video. If you think we are doing a good job, please like and subscribe to our video. See you in next video with another interesting topic. Till then, happy investing.